A year ago, there was a term that I had never heard before called AI washing. But now, you probably know what I'm talking about. In the investment world, almost everything that we look at has the words AI associated with it. I'm often asked, is the AI trade in a bubble? And I often say yes and no. Yes, in that the current valuations are at pretty high levels. The most extreme example was SpaceX, which I covered in my last video. At the same time, there are infrastructure investments being made with real dollars, and that infrastructure is likely going to pay off one day. The question just remains whether those benefits will accrue to the current investors or whether some other investor or even the general public will actually capture all of the benefits of that. So the most relevant question becomes, how do you invest in the face of that question? And our response is not to abandon innovation or even to try to call a market top. Instead, we are broadening portfolio exposure, we're reducing concentration risk where valuations have become extreme, and we're maintaining flexibility to participate in future opportunities as we see them becoming available. We don't want to become dependent on a single investment thesis, but instead we want to have many horses in the race that can take us there. That broadening came out last quarter where we saw gains similar to the S&P 500 in our international holdings and microcap. Even real estate, which has historically been a laggard, did well. The biggest loser was our natural resources sector, gold, and even oil and gas, which we would not have expected this quarter, both lost last quarter. They stand as good diversifiers, however. However, the most important market is the money market, or the market for interest rates. Specifically, I'm worried about the prospect of rising interest rates. Now, you get into the things that could help rates rise. Obviously, inflation is a direct input into interest rates. So if inflation rises, we will see interest rates rise. Additionally, we are having a problem where there is a shortage of demand for US Treasuries. This is for a lot of reasons. One is they're issuing more debt because the deficit has grown tremendously. Additionally, foreign buyers have backed off, in part because they want to diversify out of dollars for trade and other reasons, because of tariffs and because of trade restrictions. And most importantly, we have a secondary effect from the Iran war. We all know the story of the Strait of Hormuz closing. What's interesting is the countries behind that, specifically the United Arab Emirates, have not been able to export enough oil to fund their economies. Consequently, they are looking to sell treasuries. Now, when you sell treasuries, the interest rate on treasuries goes up, and central banks are big enough players that they can push rates meaningfully higher. Now, the US Treasury averted that by giving them what's called a swap line, loaning them money so that they didn't have to sell their treasuries. The problem is other countries are coming and asking for the same facility, which we can't afford to do as a country. So what's interesting is the upshot is we need to create demand for treasuries. We need to find pools of people who are saving money, who want to invest in US treasuries. I thought it was really interesting that out of the blue, there was a summit where the President of the United States, Donald Trump, went to China and met with them. And he didn't take diplomats, he didn't take military leaders, he took business leaders, because he wanted to show Chinese people the innovation, vibrancy, and quite frankly, the returns in the US economy. He took Jensen Huang, he took Elon Musk, He took a lot of the business leaders in our economy to show off our abilities. Now, why would he do this? He did this because there is a large pool of capital trapped in China in the form of domestic savings, meaning Chinese citizens have very large savings, and they don't have a lot of good options for those savings, and they would love to take those out of China and invest them in something like a US company or the S&P 500. Historically, they've only been limited to $50,000 a year leaving the country. However, it looks as if they're going to be able to buy stable coins. Now, what is a stable coin? Stable coin is simply a cryptocurrency, but each unit is backed by a dollar. So one stable coin, $1, and the way they ensure that is they have a portfolio of treasuries that they are legally required to own to back those stable coins. So you're in essence buying treasuries. Now, what's interesting is most stable coins are currently held outside of the US. So you can see them as a vehicle for people who want to invest in the US and get that stability and that nice income stream we get off bonds, but perhaps they can't do it directly. Back to China, if the Chinese savings can go into stable coins, which then goes into treasuries, that creates latent demand for treasuries, which can keep interest rates down. Now, this is a rickety mechanism, and it's unclear if it's going to work. If it doesn't work, then we could see these countries that haven't been able to sell oil, and also countries that need to buy oil, turning around and saying, hey, I need to sell treasuries. Oil's at a higher price, so I need to sell more of them to buy the oil to run my economy. What that means is we need to keep an eye on the trend on the oil market to understand where interest rates might go. I think that the interest rate question is going to be the big question for all the investment markets. Why is that? Because interest rates are tied to every single investable asset. The reason gold was down last quarter is because interest rates looked like they were going higher. Gold doesn't pay interest. Short-term treasuries do, similar stability, so then gold goes down in price. It also affects stock prices. Now, stock has the added advantage that it pays dividends and they have earnings. So they can overcome that hurdle by just out-earning treasuries, but they have to out-earn more if treasury rates go higher. That's the way to think about that. So when rates spiked in 2022, we saw a dramatic drop in the stock market. A lot of people forget that was just a few years ago, but the market at one point had fallen almost 30%, the US stock market. So you can see dramatic effects from spikes in interest rates. So that's where we're keeping an eye on things. And that just is more reason to maintain diversification and to be nimble in this interesting market. I'd like to wish the United States a happy semi-quincentennial. On this 250th birthday, we celebrate the American experiment, and we celebrate the capitalist experiment that has made companies like Camelot Advisors possible. Certainly, if you know my story and my family's story, we really are an exemplar of the American dream. And in living that dream, I'm able to help you, our clients, realize your dreams. So I want to thank you for that, and I hope you have a very happy 4th of July.